Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In this section, we're going to explore advanced strategies for investing in real estate development projects and how to maximize your returns in today's market. Construction and regulatory risks. Zoning laws, permit delays, and surprise soil issues add costs fast. A project approved today might face new environmental rules tomorrow. And construction. Budget for 10 to 20% overruns. They're the rule, not the exception. Mitigate the chaos with pre-approval checks. Have lawyers review zoning codes and title histories before buying land. Hidden restrictions kill deals. Buffer budgets. Pad timelines and costs up front. If permits take 6 months instead of 3, your funding won't collapse. Experienced local teams. Contractors who've navigated city halls before cut red tape faster. Their relationships matter. Regulations and construction delays test patience, but planning turns them from disasters into speed bumps. Risks aren't reasons to avoid development. They're just hurdles to jump with eyes wide open. The next section covers financial strategies to keep projects solvent when surprises strike. Financial planning and funding. Real estate development runs on money. How you get it, how you spend it, and how you measure success. Without a solid financial strategy, even the best projects collapse. Here's how to fund your venture and track its profitability. Financing options for developers. Not all money works the same. Some comes cheap but slow, while others move fast with higher costs. Pick the right fit for your project's scale and timeline. Traditional bank loans. Banks offer lower interest rates but demand strong credit, collateral, and detailed plans. Expect long approval times, weeks or months of paperwork, strict repayment terms. Miss a payment and penalties add up fast. Lower flexibility. Changing plans mid-project. Banks may freeze funding. Best for stable, long-term projects with predictable cash flow. Private equity. Investors pool money in exchange for equity or a share of profits. Benefits include faster access to capital, no lengthy bank reviews, flexible terms. Negotiate profit splits based on risk, no monthly payments. Investors get paid when the project sells. Downside. You give up partial control. Private equity suits high-growth projects where speed outweighs shared ownership. Government-backed financing. Programs like FHA loans or local grants help with lower down payments. Some require just 10 to 15% upfront. Favorable rates. Subsidies cut borrowing costs. Community incentives. Tax breaks for affordable housing or green buildings. The catch? Complex applications and strict usage rules. Ideal for projects aligning with public goals. Mix and match these options. A bank loan might cover construction, while private equity handles unexpected costs. Calculating return on investment. Profit isn't just about sale price minus expenses. Smart investors measure returns in layers. Cap rates. Shows annual return if you paid cash. Formula. Net operating income, property value, x100. A one-number property earning $70,000 yearly nets a 7% cap rate. Higher cap rates suggest higher risk or better deals. Use this to compare similar properties quickly. Cash-on-cash returns. Measures cash flow relative to money invested. Formula. Annual pre-tax cash flow. Total cash invested, XY100. Put $200,000 down. Earn $18,000 yearly? That's a 9% return. Reveals leverage, impact. Borrowing boosts returns and risks. Internal rate of return, IRR, estimates annual growth over time, including resale profits. An IRR of 15% beats the stock market's average 7 to 10%, accounts for uneven cash flows like construction costs before income. These metrics together paint a full picture. A project might show a high cap rate but low IRR if sales lag. Always crunch the numbers from every angle. Financial missteps sink projects fast. Budget tight, fund wisely, and track every dollar. Your returns depend on it. Case studies of successful projects. Looking at real wins gives you a clear picture of what works and what doesn't. In real estate development, below, we break down two standout projects, one in residential and another in commercial development. Each story highlights smart strategies, calculated risks, and the results that followed. Residential development success story. The Edgewater Towers. A developer spotted an opportunity in Nashville's booming housing market. With remote work driving demand for spacious urban homes, they planned a luxury mid-rise near downtown. Here's how they made it work. Location strategy. They bought an underused lot zoned for high-density housing, avoiding lengthy rezoning battles. Proximity to parks and transit added appeal. Design focus. Units included flex rooms, home offices, gym space, and rooftop gardens. Key sells for post-pandemic buyers. Phased sales. Instead of waiting for completion, they pre-sold 60% of units during construction, securing cash flow early. Outcome. The project sold out 6 months ahead of schedule, with average prices 22% above projections. The takeaway. Aligning design with buyer trends speeds up returns. Commercial development case study. The Bristol Retail Hub. In Austin, a mixed-use retail center thrived where others struggled. The developer avoided common pitfalls by focusing on two critical factors: tenant mix. They secured a grocery anchor first, drawing daily foot traffic. Smaller shops, a pharmacy, boutique fitness, and local cafes filled out the space, creating a one-stop destination. Access and visibility. The site was just off a major highway exit with ample parking and EV charging stations, critical for suburban shoppers. Within a year, occupancy hit 98% and rental income exceeded forecasts by 15%. The lesson. Pairing necessity-based tenants with easy access makes a project recession-resistant. These examples show that success isn't about luck. It's about spotting gaps, acting on data, and executing tightly. Next, we'll look at financial tools to keep your project on track. Real estate development offers big rewards, but only if you go in with eyes open. Strong projects start with smart planning, knowing the market, securing the right funding, and building a solid team. Whether you dive in directly or invest through REITs and crowdfunding, research is your best defense against surprises. Every deal has risks, but the right strategy turns them into opportunities. Learn from those who've succeeded, stay flexible, and never skip due diligence. Before stepping in, talk to experts and crunch the numbers twice. Ready to move? Start small, think long-term, and keep refining your approach. The best returns go to those who prepare. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.